So Terry, I heard you on a podcast last week talking about if you're buying a rental property today, that cash on cash return has gone into the toilet.
Hey, in the toilet, did I really say that?
Yes, you did. I'm positive I heard it.
Okay, well, I guess in the toilet is a pretty accurate metaphor.
Hmm.
But maybe I should have just said that cash on cash return really sucks today, as it has never been this low as far as I could remember. Like we're talking about earning 2 to 4% on your money if you buy in a good neighborhood.
So why be so negative about it?
I don't think I'm being negative. I'm actually just being honest, maybe rational. It's just that when we find an income property that turns our head, our minds are geared to think about what percentage we are going to earn annually on our money. More like probably monthly, what are we going to earn? Cash on cash return tells us exactly that. Not too long ago, just knowing that you're going to earn 8 to 10% on your cash on cash return gave you this cozy feeling. But in this overpriced real estate market today, you get a sinking feeling instead in the pit of your stomach when you crunch the numbers and realize the cash on cash return will only be maybe 2 to 4%.
I get it. I don't think I would bother if I was focused on those earnings.
Okay, well, most investors feel exactly that way, but it can still make sense in today's market with low yields if you go for the long buck instead of the short buck. And if you manage six influencing factors that will improve your cash on cash return. I
Okay.
will be going over these six factors in this video, along with why single family rentals are a dinosaur today, and why there has never been a better time to move up to commercial real estate.
Hello, and welcome back to the Encyclopedia of Commercial Real Estate Advice channel, where we give insider tips on over 500 real estate topics from the book, The Encyclopedia of Commercial Real Estate Advice by Terry Painter. Terry is a writer for Forbes.com and the president and founder of Apartment Loan Store, where he has financed over $4 billion of commercial loans over the past 24 years by matching each deal with over 40 of the top funding sources in America.
Cash on cash return is the most popular metric used by income property investors. It's the net cash flow from a property annually divided by the total cash you put into the property. So we have annual cash flow divided by cash invested equals cash on cash return. If you want to project your cash on cash return accurately, take your gross annual rental income and subtract all the expenses and also the annual mortgage payments to come up with your net cash flow. This is your profit. Then you divide that number by all the cash you put into the property. We're talking about closing costs, down payment, initial cash out of pocket for all the improvements you're going to do to the property in the first year as well. Okay, so let's get into it. Let's get into the six essential factors that you could manage to improve your cash on cash return. They are rents, sales price, operating expenses, value adds, financing, and down payment. So, Kriya, what do you think the most important of these factors I just told you about? What do you think the most important one is as far as influencing your cash on cash return?
So, what's the top factor that affects cash on cash return?
Yes, yes.
I would say sales price, right? Since the more you pay for a property, the less cash on cash return you would obviously have.
Okay, that's true. And you're close, but it's actually down payment. The less you put down, the better the cash on cash return will be on that amount of money. Let's say you are buying a duplex for 400,000 and putting 30% down, which is $120,000. Now let's assume that the net annual cash flow after expenses and the mortgage payment is $9,600. That works out to be an 8% cash on cash return. Okay, so let's now try putting only 20% down on that same property with the same net profit, which is $80,000. Well, your net profit isn't $80,000, but you're putting $80,000 down. In that case, your cash on cash return goes up to 12%.
Wow, that's a big difference. Your cash invested is earning a lot more because just simply because you put less down.
Exactly. But you were close, Priya. The sales price is actually factor number two. Just as you mentioned, the higher the sales price, the more you will have to put down. And as we saw in factor number one, more down payment equals a lower cash on cash return.
Okay, so what's factor number three, Terry?
Okay, factor number three is the value adds. When you are buying at today's high prices, I should say insanely high prices, you just can't afford to put too much money into the renovations. You certainly want to stay away from rehabbing a property because those are going to be priced too high. Why? Because it's more likely to cost more than you plan on. And this will murder your cash on cash return by increasing your total cash invested. So try to stick with inexpensive value adds like painting the building. Don't replace the cabinets, just paint them. New window coverings. Try just scrubbing the carpet, but if you have to replace it and you can afford it, that's okay. The new name's not going to cost much, and new signage is not that expensive either. And striping the parking lot is always a good one.
Sure. So so let me see. I'm going to guess on what factor number 4 is, and I will just say the rents because if you can raise the rents soon after buying the property, this increases your cash on cash return, right?
Okay, you got it. Increasing rents is factor number four. Any amount you could raise rents your first year will go right to the bottom line and increase your cash on cash return. But be aware, you also have to keep the property at full occupancy and make sure your tenants are paying the rent on time.
Sure.
Increased vacancy and poor rent collections can completely wipe out your profit from raising rents and really lower your cash on cash return, especially your first year.
Right.
Okay, so let's go into factor number five, which is expenses, operating expenses. Just as with rents, any amount you can lower expenses will go right to your bottom line. Focus on the four largest ones: taxes, insurance, management fees, and repairs. And also, of course, maintenance.
Sure. Yes, that makes sense.
Okay, here's factor number six. You absolutely have to get the lowest loan payments possible. This means finding a loan with the highest LTV and the lowest debt service coverage ratio, the longest amortization, and the lowest interest rate. And my God, if you could get a loan with interest only payments, all the better. Getting these lower payments and or interest only payments are the best thing. One of the best things you could do to increase your cash on cash return.
Okay. So you mentioned before that investing in single family rentals is a dinosaur today, and they've just about no cash on cash return. So is this simply because the prices for all homes across the board have skyrocketed? Isn't that right?
Did I actually use the word dinosaur? Okay,
You
no,
did.
but this time I know I used the word dinosaur. That's exactly true. So what I'm going to do is I'm going to let the numbers speak for themselves. This is going to be a little long, so I hope it doesn't, but don't switch off the video. So according to Zillow, home prices in the US went up by 19.6% in 2021, with the average home price being $320,000 at year end. So let's just lower that by $60,000 to $260,000, which is where I'm going to use an example in Greenville, North Carolina, which is about what home prices are selling for today. In this market, rents are averaging between $1,137 and $1,590. Let's take, for this example, the higher rent of $1,590. So let's just assume that you're going to have to put 25% down on a $260,000 rental home in this market. That's putting $65,000 down, and that's going to make you have to take out a $195,000 loan.
Okay.
So actually, if we take the 1,590 rent payments and rental income times 12 months, that equals total gross annual rents of $19,080. Now, let's assume average annual expenses of 42%, which is $8,014, and annual mortgage payments of $11,172. Yes, I'm talking fast. For, for a loan that's going to be at 4% and have a 30-year amortization, that's going to give you the best payments. That leaves annual net cash flow. Oh my gosh, it's so fantastic of $106. Ouch.
Oh,
That's not very good.
ouch. Yeah, no, ouch is right for sure. Um, well, having a negative cash on cash return in a lower priced home market does illustrate why single family homes at today's prices would be a dinosaur from an investment perspective. So please go on and explain, how does this open the door to moving into commercial real estate investing?
Okay, good question. Yeah, I mean, well, actually, I was planning on talking about it, but commercial real estate is just the hotter investment today. It's just where you want to be because there's just a much better economy of scale. And as an example of why you should move into commercial real estate, if you buy a commercial property that has 5 units or more, you have moved up into commercial real estate, whether you know it or not. The advantage here is economy of scale, where you have many units under one roof. This lowers the cost of repairs and maintenance, insurance, even real estate taxes per unit. Also, although multifamily properties are also overpriced today, you can purchase them for a lot less per unit. Where single family homes or duplexes, as I mentioned, we're going for up to 325,000 per unit. Apartment units are going from $140,000 to $225,000 per unit today. This is far less. So there you go.
Right. So, okay. So, what does cash on cash return look like today for apartment buildings?
Well, do you have to ask me that? Okay. Well, in a good neighborhood, you really are looking at 2 to 4% for the first year anyway. If you could raise rents by the second year, that could go up to maybe 6% or more. But as long as you can raise rents over time, it's going to creep its way up maybe to 8%. According to Zillow, rents increased 10% nationally, though, in 2021, and as much as 20.6% in one of the hot markets that I work in a lot, which is Boise, Idaho.
Hmm.
If you're able to increase your rents in 1 year by 10%, that, let's just say in the rent is $1,000 per month, that's an increase of $100 per month. And that could increase your rents from 4% annually to 8% annually.
Well, now you're making some sense here. If you liked this video, don't be shy. Leave us a thumbs up, subscribe, and leave a comment. And if there's something else that you would like Terry to make a video on, let us know. We'll see you on the next one. Thanks.